some pertinent issues that are affecting the stability of the Zimbabwean economy. Many questions linger in regards to inflation, the ZiG available in circulation, as well exchange rate instabilities. He is going to help us understand some of these questions. In studio today, we also do have a live audience, captains of industry, market watchers, economists, all who are going to help us also answer and ask questions to the governor. Eben Mabunda, my co-host, will help us steer this conversation. Eben, good morning.
Faith, good morning, and thank you for laying that platform. Now, the elephant in the room, the stability as well as the availability of Zimbabwe's new currency, the ZiG. Exchange rate stability, inflation, all of these are issues that need to be responded to. And who better to attend to those questions than Zimbabwe's Central Bank Governor, Dr. John Mushayabane. Sir, hello and welcome to Beyond the Dollar.
Good morning, and thank you for inviting me.
Fantastic. Now, of course, we do have a live audience here that's made up of industry captains, members of the SMEs, as well as economists and analysts who are part and parcel of this very podcast. Please note that there will be a question and answer segment where it is that these industry captains will get the opportunity to raise pertinent issues to the Central Bank Governor. As well, there will be an opportunity for you, our online audience, to raise your questions as well as your concerns via our social media handles at Zim Papers TV Network as well as at Z10 Prime. Your views and your thoughts are important to us. Now, I will start off by engaging in conversation with the Central Bank Governor. Then later on, we get into the Q&A segment of this very podcast. I'm Eben Mabunda, the Money Man. Let's get started. Now, Dr. Mushayabane, one of the critical pillars of the NDS1 is macroeconomic stability, which also focuses on inflation stabilization as well as economic growth. Next month will mark about a year since you assumed captaincy of Zimbabwe's Apex Bank. Now, the question is, during your time that you've been in office, what were your contributions to the achievement of the NDS1 objectives?
Well, thank you. As you rightfully said, the role of the Reserve Bank under NDS1 is, number one, to ensure currency stability. Number two, to ensure financial sector stability. Number three, to ensure that inflation is under control. And also to ensure that financial inclusion is taken care of. And when I look back over the nearly 1 year that I've been in office, I think we have achieved all the key measures that we were supposed to be implementing under NDS1. If you look at exchange rate stability, I think you will agree with me that from the time we launched the structured currency ZiG up until now, we have seen relative stability. Yes, there was that movement that occurred in September, which we'll talk about later, but besides that, there has been relative stability. From an inflation perspective, you also agree with me that we have seen very stable inflation, and as a matter of fact, the month-on-month inflation for the month of February has just been released, and we are on 0.05% ZiG inflation. That has never been achieved in local currency as far back as I can remember. And when you look at financial sector stability, all the banks are operating profitably. They are in a sound position. Their capital positions are as per the regulatory requirements. When you look at financial inclusion, I think we are rated very highly in terms of the extent to which we have embraced financial inclusion in this country. So I can say under NDS1, we've achieved what we were set to achieve.
Right, and of course the NDS2 will be expected to be released and pick up from there. Now perhaps as follow-up to your initial submission, where the stability of the domestic currency is concerned, relative stability you pointed out, questions then would be raised by your critics as to the quality of that particular stability, given the fact that there hasn't been perhaps as much widespread adoption. If you travel to Checheche or to Gweluchena, Chendambuya, you'd find there are other kinds of currencies that are at play and not as much the widespread adoption of the ZiG. May you speak to the quality of the stability of Zimbabwe's new currency?
Yeah, well, it is not true that the ZIG has not been widely embraced, and I will explain it further. Remember, we are in a multi-currency regime. Multi-currency means you can use US dollars or any other currency, and you can also use the local currency ZIG. What we have seen is that currently 30% of the transactions that are being done in this country are being done in ZIG, and 70% are being done in US dollars. When I came in, the ratio was 80-20. 20% of the transactions were in local currency, and 80% of the transactions were in foreign currency. What it means is that we are gradually increasing the usage of ZIG in the market, bearing in mind that we've got 2030. By 2030, we want the ratio to be 100% ZIG, 0% foreign currency. So as far as adoption of ZIG is concerned, I can tell you that the figures are showing that it's increasing. So why is there no ZIG in Checheche? Why is there no ZIG in the rural areas? First of all, you should remember that we are coming out of a drought here. For someone in the rural area to get ZIG, they have to be involved in an economic activity that requires them selling something in exchange for ZIG. Now, if they didn't produce enough maize, then it means that they are not expecting any payment from the GMB, so they will not get ZIG. So you will find that when you go to the cotton producing areas, there you will find ZIG in circulation, because the cotton marketing companies came to us and said they wanted ZIG to be able to pay the farmers for the cotton delivered. And so you will find ZIG in those areas. But you will not find ZIG in areas where there has not been that much economic activity because of the drought. So I would want to disagree with you that ZIG has not been fully adopted. In fact, we are increasing, gradually increasing the usage of ZIG. Also, let's differentiate between cash ZIG and electronic ZIG. When you look at electronic ZIG, transactions are happening daily in electronic ZIG. And as regards cash, we have taken a gradual approach to ensure that we bring into the economy the various denominations as and when the demand is there. So far, we've done 10 ZIG, 20 ZIG, and also the coins. But as we go forward, we'll be introducing higher denominations.
Right. 30-70 is the ratio that you present. Does that also cater to the informal sector of the economy?
It caters to everyone. But you will find that the informal sector is largely driven by cash. And therefore, the ratio maybe can be more in favor of US dollars because of the cash element.
Right. So critics then would contend that if this 70-30 is the ratio that's at play where the formal sector is concerned, could it be that maybe we're looking at a 5% adoption in the entire economy, given the fact that the informal sector has not been affected in where that 70-30 is concerned? At the same time, you make reference to how there's a difference between the electronic as well as the cash availability across the economy. And yet, where the other quarters of the economy, you've got the United States dollar and several other currencies at play. But where the usage of the ZIG, that remains very much a concern. And perhaps critics would contend that there would be need to see to it that there is increased circulation of that hard cash.
Well, certainly, yes, I agree with you that there is need to ensure that there is increased circulation of the cash. But it is also not true to say that the informal sector is not using ZIG. And that 5% figure, I don't know where you got it from, but I don't think it is accurate. Because remember, the informal sector are also trading with the formal sector. And they are using ZIG in that process. And in that process, I'm talking of electronic ZIG, which is when you swipe and when you also do RTGS transactions and so forth.
Right. Speaking of the quality of the stability, I want to make reference to one of the financials by one of the listed companies in Zimbabwe. OK, Zimbabwe, of course, they've had their own management issues, which they are trying to put under control. But let me make reference to their third quarter statement, which highlights what transpired as and when there was a 44% devaluation of the domestic currency. And their statement reads, The local currency unit, the ZiG, experienced a sharp devaluation at the end of September 2024 as monetary authorities sought to improve the viability of the exchange rate system for the broader economy. Now, here is where it gets interesting. Invariably, the devaluation had the net effect of nearly doubling existing US dollar denominated obligations in loans and creditors' balances. And this speaks pretty much to the impact of the currency devaluation on the 27th of November. May you shed more light on that?
Okay. First, let me correct you. What happened in September was not a devaluation, but a depreciation of the currency. A devaluation occurs when a country has got a fixed exchange rate and the authorities make a deliberate decision to devalue the currency. We don't have a fixed exchange rate in Zimbabwe. We have what we call a willing seller, willing buyer rate. Now, that rate is supposed to be adjusting on a daily basis, depending on what the sellers of foreign currency are wanting to sell it and what the buyers of foreign currency are wanting to buy it. So there was a confusion, especially amongst banks, when we introduced ZiG. The 5% cap that they were talking about was only meant for trading on the first day of the introduction of ZiG. Otherwise, the arrangement that we have in this country is that if you have 100 US dollars right now, you can go to your bank and say you want to sell it at any exchange rate that you want to sell it. Your bank will then look to if they have got buyers that are prepared to buy at the rate that you have asked for. Let's say you go in and you say you want to sell at 40. Your bank will obviously want to find a buyer who is prepared to buy at 41 or more. If they can't find, and the buyers are saying they want to buy at 25, they will tell you that, sorry, we can't accept your rate because we will not be able to sell it, because the bank cannot take an exchange rate loss on your behalf. I'll give you an example of what happened recently. A bank came to us as the central bank and said they were selling 5 million US dollars. We said, yes, we would want to buy it, but our rate is 25. They said, your rate is too low. We said, fine, go and look for a buyer. They went out there the whole day. Later on came back and said, okay, we are willing to sell it to 25, which means there is a supply and demand and willing seller, willing buyer arrangement in this country.
Right.
So it's not true if you are saying there was a devaluation. Yes, what happened was that there was a depreciation.
All right. Perhaps I would present it perhaps from a semantic perspective, given the fact that some contend that it's not a free float where the exchange rate is concerned, with some critics contending that perhaps there is also some activity that's coming from the central bank that is aimed at perhaps managing the floating of the exchange rate and, of course, trying to bring stability to the domestic currency. But then again, question would be asked with regards to the impact of that depreciation.
Let's first of all address this invisible hand that you are talking about.
Right,
where
the invisible hand.
Where you are saying the central bank is interfering with the exchange rate. Again, that is not true. As I said earlier on, what is there is a willing seller, willing buyer trading arrangement. Let me just give you some figures. Total deposits, ZiG deposits in this market are at about 14 billion ZiG, just under 13 to 14 billion ZiG. Our reserves right now are approaching almost 600 million US dollars. The reserves that we have to back the currency in the form of gold and in the form of foreign exchange that we have in our nostro accounts in New York. Now, if you divide one by the other, you find that you get an implied exchange rate of about 22. What it means is that if, as the central bank, we wanted to buy back all the ZiG that is in the market, we could do that at an exchange rate of 22. So if we wanted to control the exchange rate as the central bank, it would not be above 22, because that is the only logical rate that we can think of that will be able to clear the market of ZiG. But we have this willing seller, willing buyer trading arrangement where willing buyers will go and say to the bank, I'm prepared to buy Forex at this price. Willing sellers will say, I'm willing to sell at this price. And along the way, they find an equilibrium.
And yet,
now, there's also the power market. You are saying, why is there a willing buyer, willing seller exchange rate of about 26, a power market exchange rate of about 30, 31? The reason is very simple. First of all, on the formal market, when you are dealing with invoices that are legitimate, you go to the willing seller, willing buyer market in the banks, and they will be able to sell you at that rate.
Right. And
anything
yet,
that happens on the parallel market is illegal and there's got a premium.
Right. There remains concerns that there are more buyers on the market than there are sellers who are willing to dispose at those particular rates that you just made reference to.
Actually, that is not true as well. You see, when you look at sellers, we are looking at it in volume terms, because sellers are those people who are generating foreign exchange from exporting. So if you look at the amount of money that they are selling, especially through the export surrender, it's more than the amount that is demanded by the buyers. Let me give you again another example. Yesterday, we went into the market as the central bank to sell forex into the market from the export surrender. We went into the market with a figure of about, we went in with 20 million US dollars. The banks were only able to buy 15 million US dollars. In other words, that was the demand that was there in the market to clear all the outstanding invoices. Right now, as we speak, if there's anyone who has an import invoice or who has a foreign payment that they need to make outside the country and has not made it, they can go to their bank and it will be honored, because we don't have a foreign exchange problem. The supply of foreign exchange in this market compared to the demand is higher.
Right. Let's move on to another subject, which has to do with what's playing out in Zimbabwe's banking system. We continue to have mattress banking, and week in, week out, there are reports of someone who would have been robbed of their 5,000, or a corporate player that would have been robbed of, say, 20, 30, 40, 50,000, which some would decode as the absence of confidence in the banking system. May you speak to the efforts that you've put in place to try and address some of those challenges?
Right. If you look at the measures that we included in the recent monetary policy statement, we were trying to address that issue. First of all, let me talk about the increase in the amount that you can put in your MasterCard or in your Visa card from 500,000 to 1 million US. We are saying people can go and bank their cash in an instrument that will enable them to buy things online or even to travel and go and buy. So we're making it easier for people to put money in their account and save. Secondly, interest rates. We upped the minimum interest rates that banks are compelled to pay on savings and time deposits. Again, people have been complaining to us that when they bank money in the bank, all they do is pay bank charges, they don't get interest. Now we have said, if you are prepared to leave your money in a savings account, or you are prepared to put your money in a time deposit, there is interest that the banks can pay. We also, especially for the vulnerable, put in a measure that took care of the cry from the public on bank charges. And we have a measure in the monetary policy statement which says any balances below 100 US dollars or ZiG equivalent do not attract service fees. In other words, if you leave 100 US dollars in your account and you go away for 10 years, you should expect to find your money there as $100, if not more. In the past, you would find that you actually owe the bank. We also introduced another measure where all transactions below 5 US dollars or ZiG equivalent have no bank charges whatsoever. In other words, if you go and swipe $1 US to buy a loaf of bread, your account will be debited with $1 US. In other words, there are no bank charges. It's as good as cash. So all those measures are meant to instill confidence in the banking sector.
Right. That aggregate that you just spoke to, some contend that it would pretty much be on the low side. And perhaps to further elaborate, when you look at Zimbabwe's banking sector, banks are, engaged more where fees and commissions are concerned than it is that they are given to lending, which is supposed to be their principal form of business within the economy. And so given that particular matrix, the argument then would be the regime that we have is pretty much punitive where the ordinary citizens are concerned.
Well, to some extent, I would agree with you. And the central bank has been engaging banks, especially on the area of bank charges. We want them to concentrate on their core business, which is lending. But however, this is why we put in place those measures to address especially the vulnerable. But for the enlightened, I see some of the people in the audience are quite big corporates. What I've always said to the corporate, because remember, I used to be a banker before I came to the central bank. And when I was in banking, especially the large corporates would come to us as a bank and say, you are charging me $10 to do a TT. The bank next door has said that they can charge $5. If you want my account, make a decision. Do you want to charge $5 or you want 10? And we'll sit down and say, do we want to lose this account? No. And we'll reduce the price. So I'm trying to say that the consumer, especially the corporates, have got negotiating power. You can go and talk to your bank and
what about
get
those that don't have that negotiating
those are
power?
the ones that
That's
we,
where
those are the ones that
comes
we have
in.
protected in the monetary policy statement, because we put in those measures to protect those ones.
Right. That 5 aggregate you spoke about, some content is a bit on the low side. Any efforts to increase that? And may you speak to the practicality of this regime that you've put in place? Because as it stands, this remains to be the order of the day, where mattress banking continues to be taking place within the economy, and perhaps not as much traction where the banking system is concerned. Perhaps more could be done to try and change that narrative.
Yes, we will continue to engage the banks and review that. But also, I would like to caution the public. You can do mattress banking, but we are increasingly seeing robberies taking place. And your money is safer in the bank. We have put in place measures where you can get interest on your investment in the bank. That's number one. And number two, there are fake notes that are circulating in the economy. Banks have got the ability to say, this is a fake note, this is not a fake note. But if you are just circulating the money amongst yourselves, in your communities, in the informal sector, without that money reaching the banks, you never know. Maybe you could be dealing with fake notes. So I would urge people to go and bank their money, because when you bank it, banks are able to then say, yes, these are genuine notes.
Right, so which means that more needs to be done from an incentive perspective.
Absolutely, yes.
All right. Moving over and beyond that particular subject, and looking at some of the issues playing out in the economy, a tight liquidity, tight monetary stance that you've taken, given that we've got high interest rates playing out in the economy, you maintain statutory reserves pretty much on the flat side, and some would argue that that's perhaps affecting the productive sectors of the economy. How do you respond to that?
It is not affecting the productive sectors of the economy, because, again, I would like to disagree with you that there is tight liquidity in the market. From October up until today, the market has been long by over 1.5 billion ZiG on a daily basis. What it means is that after the banks have done all the transactions that they've done, there is 1.5 billion that still has not been deployed. So the problem is not tight liquidity. The problem is that banks are not trading with each other. The central bank has been taking that excess liquidity on a daily basis and putting it into what we call non-negotiable certificates of deposit at zero interest. So you have banks that are happy to have surplus money on their position taken by the central bank at zero interest and locked away in these NNCDs, instead of lending to the bank next door and you earning interest. So that is an issue that we have to address. It's a
All right,
structural
and-
issue
and-
within the banking sector, but I haven't finished answering the
I was about to say that remains your responsibility as the central bank.
No, it is not the responsibility of the central bank to force bank A to trade with bank B. But what have we done to
Incentivize.
resolve it? We take that money from the bank that does not want to lend to the other bank, we put it into NNCDs, and then we lend it back to the bank that wants to lend. So that is our role, to make sure that the money is circulating. And this is also the reason why we introduced the targeted finance facility, again, to make sure that money is circulating in the economy.
Right, 35% interest rates, 30 at the targeted finance facility. Again, business would contend that this remains very much on the high side, given the fact that when you look at some of the players, some of the economies within the region, the interest rates obviously are on the low side. How can we navigate that and ensure that there is more funding that is flowing to the productive sectors of the economy? It's not a public secret that we have seen the growth of the informal lending market, where high interest rates of 30, 40, 50% are being charged because ordinary citizens and some businesses are failing to access the credit that they need, and perhaps there are concerns with accessing credit owing to the regime that is there from that perspective.
Okay. First of all, you need to understand how the Monetary Policy Committee determines the policy rate. For an economy to prosper, we need what we call positive interest rates. By positive interest rates, we are saying the rates that are prevailing should be higher than the rate of inflation.
Than the inflation, obviously.
Right. Now, we have not had year-on-year inflation for ZIG from April, because ZIG is a new currency. What we have had is month-on-month inflation. The first year-on-year inflation for ZIG is going to come out in May. And when you do the extrapolation of the numbers, it's going to come out at plus or minus 70%. Now, that 70%, when you compare it to 35%, are we positive or negative? Right. So that is one thing that we should take into account. So obviously, when we get to May and we start projecting forward, we are seeing a situation where we'll end the year 2025 at an inflation rate of between 20 and 30%. So that is the basis on which the Monetary Policy Committee will be reviewing the policy rate as we go. But for now, the policy rate is actually properly pegged where it is. In fact, there are some economists, some analysts who are actually saying maybe it should be higher than what it is, given the figures that I've just given you.
Right. Now, let's talk about what we have witnessed as an economy in the recent past, or should I say, for quite a while. Of course, that speaks to the money printing, and that's been a concern given, of course, the inflationary impact that would have on the macroeconomy. May you speak to the efforts that you've put in place to try and rein in that and bring about macroeconomic stability?
Yeah, when I went into the central bank on the 28th of March last year, I did promise the nation that at any one time, the amount of ZIG in circulation will be backed by reserves. Any increase in the amount of ZIG will be followed by a concomitant increase in reserves. And we have walked that talk. So this is why I gave you the figures earlier on to say we've got between 13 and 14 billion ZIG circulating in the market. And we've got almost 600 million US dollars worth of reserves. And we are tracking those. And when you then do the cross exchange rate, that's where we came up with an exchange rate of 22. So we are saying where we are, the local currency that is in circulation is fully covered by the reserves at the exchange rates that are prevailing in the economy. And that is what we are going to continue doing going forward. Gone are the days when the central bank would print money for the sake of printing money. We're not going to do that.
Right, and yet several government departments and several contractors out there remain unpaid. And there are fears that as and when those particular payments get to be made, that would have an inflationary impact on the economy.
No, there will be no inflationary impact when those contractors get paid, because the contractors are being paid from money that is already circulating in the economy. What happens is that Treasury collects money in the form of taxes, which is money that is already in the system. It's not printing. And after they collect that money, they pay the contractors. There is only inflation if we have a situation where Treasury borrows from the central bank to pay the contractors. And that has not happened since I came into the central bank. I think I've been on record for saying there is no overdraft facility for Treasury at the central bank. And I'm in agreement with the permanent secretary in the Ministry of Finance. He has no appetite from borrowing from the central bank either. So any misconception out there that the government could be monetizing the fiscal deficit through borrowing from the central bank is not true. As we speak right now, Treasury does not owe the central bank anything. In fact, Treasury has got positive ZIG balances, positive US dollars in their exchange account at the Reserve Bank.
Right. Well, that, of course, remains one of the issues that many economic agents would be, of course, on the lookout for, to find out how things play out as the year progresses. Now, I'll ask this.
Well, they've never believed in us. You know, when I said that we've got reserves, they were doubting that we've got. We even went to the extent of getting a foreign audit firm to go and audit the gold reserves that we have. So the doubting Thomases who think that Treasury will borrow or has borrowed from the central bank will only have themselves to blame when they discover that that is not the case.
Right. We are coming from a severe drought, which saw the government spend quite a lot on grain imports. Are we likely to feel the impact of this on the currency as we go further into the 2025 fiscus?
Yeah. What you should be aware of is that grain imports for 2024 were in the budget. So they were financed from revenue collections by Treasury. And also some were financed by the private sector. Remember, we are in a multi-currency environment. If someone has got US dollars and they go and import maize and then they sell the meal, again, this is self-financing. It's the private sector that is doing it. So there is not going to be any spillover effects arising from that to the central bank or to the currency or to the economy. And fortunately, as we go into 2025, the rains are falling and we are predicting a very good rainy season. So there shouldn't be any problem for us having to import grain in 2025.
Right. Now you speak to the anticipated inflation in terms of where inflation could possibly close the year at. Of course, at this point, we would be speaking from a month-on-month inflation perspective, but also your projections and as far as the year-on-year inflation is concerned.
Well, the central bank is determined to ensure that we keep inflation under check. And as I said, the February month-on-month is on 0.5. And but remember, it's not just that we should be containing inflation. We should also be mindful of the fact of the need for economic growth. So if you look at this year's budget, we are projecting growth of 6%. And in line with that, we are also projecting that inflation will end the year-on-year ZIG at between 20 and 30%.
Right. Thank you very much, Governor. Time for us to take a quick break. When we come back, we take a look at some of the questions that have been brought to the fore by industry captains that are a part of our live audience. We'll also be taking a look at what are your submissions via social media handles at Zim Papers TV Network as well as at Z10 Prime. Don't go anywhere.
watching a special podcast of Beyond the Dollar right here on ZTN Prime. We are broadcasting to you live from our studios in the capital of Harare, Zimbabwe. Before the break, Ibn Mabunda was in conversation with Dr. John Mushayawanu, talking and discussing about exchange rate issues, inflation, and so forth. Now we are going to rope in captains of industry, some market watchers, some experts that we do have in our studio today. Ladies and gentlemen, thank you so much for joining us. Now, the floor is open to you to ask questions. We are going to be taking rounds of 3 questions per round, and then we're going to pose them to the governor so that he can address them. When you do ask your question, please do make sure to stand up, give us your full name, and you can go ahead and ask your question. I'm going to take the first 3 now.
Thank you, Faith. My name is Meshach Ugaro. I'm the Vice President of the Zimbabwe Economic Society. I also am on the Technical Advisory Committee of the Employers Confederation of Zimbabwe. By way of background, I am an ex-banker, experienced in these currency regimes in the SADC region, Mozambique, which had dual currency, Tanzania, which had dual currency, Zambia, which had dual currency. I didn't experience Malawi, but I also experienced Botswana, which had the most stable currency regime and an open exchange rate. So my comments and questions will be aligned through that line. But first of all, congratulations, Dr. Mushayawanu, for, I'm saying it in advance, for your first year, I think, because I don't think we'll meet again before the end of March, for your first year of governorship at the Reserve Bank, and we are seeing the changes. I think congratulations are in order. And the consistency also, I think, is what is most telling. I think what is coming out is consistent since you went in. So that creates some positive market expectations aligned to what you would have presented or what would have promised the market. Now, by way of commenting, I just wanted to take up the issue, and the governor is aware of my position regarding the banking sector in Zimbabwe, and I acknowledge that, in fact, there's been a response regarding the charges. But I think the fact that banks are willing to put money to the central bank, their excess liquidity to the central bank at 0%, instead of lending that to industry or business, which is crying out for liquidity, I think is a telling sign of something not adding up. And I'm questioning the transmission mechanism of policy into the market, because the players that are supposed to transmit policy seem not willing, unfortunately, Dr. Governor, because we saw it even in the central bank's attempt to make cash available to the market through the HomeLink cash points. When we have banks, it's unprecedented that the central bank would go out to the market to ensure that market has access to cash when there are banks. We expected the banks to be dispersing that cash. But today, if you go to a bank wanting to cash out 10,000 ZiG, you'll be told you don't have it. But if you go to a HomeLink, you can cash 3,000 at any point. So why is it like that? I'm challenging the central bank to relook at our banking sector and really see what is really happening there. The second point is regarding the issue that Eben discussed. I do acknowledge the exchange rate is stable over the last 6 months. Yeah, even overall from the April, there was that dip in August, yes, in September. But generally it is stable. In fact, it's appreciating, even on the parallel exchange. But the risk that he spoke about of the fiscal side, treasury, perhaps not really aligning with the policy moves from yourselves as the monetary authorities. I know you said that the release of payments to contractors will not affect inflation. But what happens here, Dr. Governor, is the transmission to exchange rate from the money supply is not direct. Unfortunately, it is through the exchange rate. So Zimbabwe has a unique case where it is the exchange rate that drives inflation at the moment rather than money supply. So when the contractors get paid, they move on to the parallel market to buy US dollars, and the exchange rate moves, and then inflation goes in. So I would like you to comment on how that is going to be neutralized or sterilized. Thanks so much.
All right, I will allow the governor to respond to those questions before we move on and take more.
Yeah, okay. Thank you very much for those questions or comments. I think on bank charges we are aligned, and as I said earlier on, the central bank is working with the banks to make sure that they go back to core business, which is the business of lending money. And also, as the economy and the banking sector digitalizes, you find that the cost of maintaining an account or the cost of doing a transaction will go down, and ultimately we are also going to see banks reviewing their charges downwards. There is a lot of disruption that is going on in the banking sector, where players are coming in with payment mechanisms that are cheaper, and so the challenge is out there. If the banks don't change, they will be pushed out of the market by more efficient players. Now, the issue to do with the transmission mechanism, where you get a situation where some banks are not willing to lend, also some banks have the cash from the central bank, but they are not willing to pay it out, again, is an issue that we are addressing. Hopefully, because it's a carrot and stick arrangement. If we take money from you at 0%, surely you have to account to your shareholders as to why you are not making money. Because the opportunity cost of you not lending that money means that you are foregoing certain income that you should be getting. So hopefully banks will wake up to that. But I think it's mostly been driven by previous perceptions on the local currency. People have always believed that the local currency will always depreciate. So they will be doing their maths to say, if I lend money today at 35% and the currency is depreciating at 100%, I'm losing money. But as the central bank, we have now walked the talk. We're almost going full year, currency is stable, and I'm sure that should force the banks to then rethink their strategies to say, this currency is stable. If I had lent this money at 35%, I would have made money because inflation has been contained. So the same applies to the issues to do with cash. So it's an ongoing conversation, and we are on the same page with you, Ms. Tuka. Then you talk of contractors, when they get paid, even if they are being paid from money that is already in the system, they'll end up going to the parallel market. But increasingly, we are seeing that on the parallel market itself, even for that contractor, they are seeing that they cannot sell their currency. It may be 35 or 40 simply for the purposes of getting the US dollar, because that ZiG is actually stable. So why would you forego value just to get the US dollar when in fact overall in the economy, the US dollar exchange rate to ZiG has been stable? So again, that realization is what has resulted in the parallel market strengthening. In other words, we were hearing rates of about 35, now we are hearing rates of 30, but you are going to be hearing even lower rates. Why? Because as we go into March, which is QPD, the demand for ZiG is going to be increasing. We saw it in December. People holding ZiG were being called by their banks to say, can we buy your ZiG? Because there are people who are holding foreign currency, but when it comes to paying tax, they are supposed to be paying that tax in ZiG, but they don't have the ZiG. So the time has now come for the holder of a ZiG balance in a bank to dictate the price, as opposed to what was happening in the past. I hope I have answered your question.
All right, now we're going to take 2 more questions.
Good morning, and thank you, Governor, for sharing the effort of the bank. My name is Wisbon Malaya. I'm the Secretary General of Zimbabwe Chamber of Informal Economy Associations. Firstly, just to appreciate your effort in trying to stabilize the currency. We know, and we have been following, that the informal economy has been termed the most criminal element in terms of the financial instability of the country, which from our perspective, we feel it's not the correct perception. However, just to share a few things, automatically this may not be practical at this juncture. There are many baby steps to be taken for such a person to get to that level. We appreciate that in terms of opening accounts, we have to appreciate there are many forms of account opening which are simplified and that most everyone can. But the issue is about, is the money being generated at that type of business able for one to then open an account? Then we have also categories of people who definitely need to open an account and be regularized. However, the licensing process is cumbersome and expensive. We request for a harmonization of the licensing process to be as much simple as possible so that it's attractive for many people to register. At the moment, what we have seen in the market, because of the monetary policy, there is high criminalization of the same target group we want to formalize. The police are just arresting, making people pay fine. Local authorities are coming from their angle, arresting, making the same people pay fine, of which these are the same people we want to participate in the mainstream economy toward 2030. So we request that let there be a review of the approach. We reduce criminalization, we promote participation of the target group. The last point I have is the issue of the ZIG. Within the sector, especially the lower part of the sector, ZIG is a critical player for the trade. Consider introducing a lot of coins which are equivalent to 50 cents for the purposes of simple trading and exchange, even for transportation. We feel if this approach is taken, it can also contribute a lot toward your effort. We then request that when you...
Thank you very much for that question. We'll allow the Central Bank Governor to respond